Hello, this is Domenico with Easynomics, and we're going to utilize a real-world example in the context of a Paper 2 exam, but this real-world example can also be applied in the Part B section of a Paper 1, and it also can give you some insight on how to dissect real-world articles for an internal assessment. Our applied example would be the Russo-Ukrainian War, particularly the increased invasion of Ukraine in 2022 into the eastern portion of the country. According to the Wikipedia site, it's an ongoing war from 2014, which began with Russia annexing Crimea, but then was further escalated in 2022 of February with the full scale invasion on the eastern front there. When this invasion took place in February of 2022, we can see here over a 5-year period how crude oil prices spiked right at the beginning of this invasion and remained relatively high, trading at above $100 a barrel, and then eventually collapsing to, it looks like, about $71 a barrel currently. But with that initial invasion and sanctions imposed on Russia, and thus reduced supplies of petroleum to those countries that are imposing those sanctions against Russia, that would cause the supply to decrease and, of course, the price to rise, as we see here. So that's going to be our focus in this video. In a Paper 2 exam I wrote back in June of 2022 for my students, I utilized these real-world examples or real-world articles, which will be linked in the video notes below. One was from Bloomberg, looking at OPEC as a collusive oligopoly and the impact of rising oil prices and whether or not this collusive oligopoly will increase global supplies to reduce price. Also looking at reactions, in this case with Catalonia in Spain and Spain itself, and how will they address rising energy prices. And in this article, it highlights that the Spanish government is utilizing a 20-cent per liter per unit subsidy for gasoline to impact transportation, truck drivers, and households also using cars to get to and from work and other places. And then finally, I used this article within that paper too. Bank of Spain calling for lower indirect tax rates as opposed to them being increased to also reduce prices for consumers. So that will all be linked below. So let's start getting into the exam. So here we have the snippets of text that I took from those 3 articles. Text A, again, looking at the collusive oligopoly. Text B, a solution being provided by the Spanish government of a per unit subsidy on fuel. And then text C, also addressing Spain and potential solutions like reducing indirect taxes and so on. So let's take apart this exam. The exam for paper 2 typically starts with some maybe definitions or short answer questions. Here we have defining a subsidy, define a collusive oligopoly, perhaps some math. I didn't include too much math on my paper 2 here, maybe giving the formula for, in this case, gross national income. But for this video, we're going to focus on this first question here. Part B, I, using an appropriate market demand diagram, illustrate the relationship between price and total revenue, and explain the factors that determine the price elasticity demand for petroleum, with reference to text A, paragraph 3. So let's take a look at that. So here we have text A, paragraph 3, and we're looking, let's see if I can make some highlights. Here it highlights that there's no refining capacity that corresponds with the current demand and the expectations of the rising demand in summer. So this is basically highlighting how petroleum exporting countries are expecting rising demand as we exit the pandemic. And as we get into the summer, there'll be rising demand for petroleum as people take to the highways for vacation, but they're at full capacity. And this will affect their supply curve. Their supply curve will be very inelastic. This is a determinant of PES. So the supply curve is going to be very inelastic because they're at full capacity. Go on, it explains soaring demand ahead of the peak U.S. driving season is sending refining profits and revenue to extraordinary heights, benefiting refiners including Saudi Aramco. So that is a clear indication that the PED, the price elasticity of demand for petroleum as a primary commodity, is going to be very inelastic, whereas price rises, profit increases, total revenue increases. So let's begin to graph and analyze that. Again, looking at this question, we're going to illustrate the market demand for petroleum and focus our analysis on how, as price rises, the impact on total revenue. Okay. So here we have our model. Graph A will be the global market for crude oil. We're going to measure price on the y-axis and quantity on the x-axis. Again, this real-world example could be used for a Paper 1 Section B. Here we are getting some practice on Paper 2 and also gives us some insight into how to dissect an article for an internal assessment. Great. So first, let's think about the determinants of PED. And in the IB syllabus, it's focused on these four elements: the number and closeness of substitutes, necessities versus luxuries, length of time, proportion of income spent on a good. Now, proportion of income spent on the good is typically looking at the demand by the household. Length of time could also be looking at the impact on the household and their ability to adapt to rising or falling prices. Can they find alternatives in the short versus the long run? Necessities versus luxuries also kind of focused on the household. Number and closeness can also be focused on the household, but we're going to use this for the firm. Household or firm. So we want to keep in mind that this is the global market for crude oil, and it's not the household that is demanding crude oil. It is the firm, right? Firms are demanding crude oil for their production process. So firms demanding crude oil for an input for production. So demand is driven by firms for crude oil as an input. And that demand is being driven by oil refining companies. All right, so we're going to assume that oil refining companies, they're going to refine oil into some type of petroleum byproduct like gasoline. Oil refining firms will take crude oil as an input to generate some type of output like gasoline or plastics and so forth. And that will be the output. And that output would be consumed by the household. Gasoline consumed by the household or by firms that use gasoline for transportation of goods and services. So the demand here for our purposes is driven by firms, and they're going to demand crude oil to produce something. It could be they're going to produce gasoline, but they need the crude oil as an input. So if that's the case, of the determinants of PED, the number of closeness substitutes is the quality that's impacting the demand curve. There is no alternative for these oil refining firms. Crude oil is absolutely essential. It is the key input. There's no alternative. So the demand curve is going to be very inelastic. So let's go ahead and illustrate that. So here we have this very inelastic demand curve driven by oil refining firms. We're going to label that D1 is equal to our marginal benefit, which is equal to our average revenue for those students who have done theory of the firm. Perfect. So let's start with an initial lower price. Okay. So here we can see, going back to this chart, oil prices were relatively low. So our P1 value could be somewhere around $70 a barrel, and then it spikes up to over $100 a barrel. Looks like it's going up to 120. Okay. So we're going to have a low initial price with a quantity demanded here. Here's price at P1 with a quantity demanded at Q1. Here is our initial point of A. And then due to the Russo-Ukrainian War, sanctions imposed on Russia, reduced global supply, that causes the price to rise. So from P1 to P2. Going from point A to point B. What's causing this? Reduced supply. So if we want to, we can draw a supply curve coming across here, and it's shifting in to this point, driving that price up. But since the question's just asking us to focus on demand, this is enough. So let's make some notes here. Primary commodities, every higher level student and standard level should know this. Primary commodities. Things that are directly extracted from the land, could be crops, fish, timber, mineral resources. Anything that's directly extracted from the land is a primary commodity. And for primary commodities, every economist knows that the PED value, the price elasticity of demand value, is going to be less than 1. And we know as economists that PED is a formula. PED is equal to the percent change in quantity demanded over the percent change in price. And if the PED value is less than 1, that's going to tell us that the percent change in price is greater than the percent change in the quantity demanded, which we can clearly see here. We can clearly see that the change in price from P1 to P2 is greater than the change in the quantity of demand from Q1 to Q2. If that's true, then we would expect that, as in this case, as price is increasing, if it's predominantly inelastic demand curve, then total revenue should be increasing as stated in the article. So if we go back to the article, all right, text A says here, sending demand ahead of the peak driving using, it's sending refining profit margins and revenue to extraordinary heights, benefiting refiners like Saudi Aramco. So again, this model can help us understand that. Just for further knowledge, just to ensure that you understand this, if PED is less than 1, let's say that the PED value for crude oil by oil refining firms is 0.2. That tells us that if that's the change in quantity demanded, I can put what's the change in price to 0.2 over 1. And that tells us that for every 1% increase in price, the quantity demand will only decrease by 0.2%, a very small decrease in the quantity, even though the change in price is greater. Okay. So let's also label a few areas here. I'll label this area A, B, and C, and then I'm ready to begin to analyze this for a paper 1 exam. So let's go ahead and analyze this as we would for our exam. As can be seen in graph A, we're looking at the global market for crude oil. We're measuring price on the y-axis and quantity on the x-axis. We have a downward sloping demand curve labeled D1 equal to our marginal benefit, also equal to the average revenue. And the demand curve is predominantly inelastic, so PED is less than 1 because crude oil is a primary commodity. PED being the percent change in quantity demanded, which is divided by the percent change in price. If it's a primary commodity, thus the percent change in price will be greater than the percent change in quantity demanded. And if that's true, as price rises along a predominantly inelastic demand curve, the total revenue will also increase, as explained in text A, paragraph 3. So we'll start with an initial price at point A, price at P1 with the quantity demanded at Q1. And due to the Russo-Ukrainian War, sanctions imposed on Russia, reduced global supply, that drives the price up from P1 to P2. leading to a reduction in the quantity demanded from Q1 to Q2. Here we notice that the change in price is greater than the change in quantity demanded, emphasizing that the PED is less than 1. What is the impact on the total revenue? Initially, total revenue was equal to price P1 times quantity Q1, which is also equal to areas A plus B. All right, let's highlight that. So here we have the initial total revenue. Okay. And then as prices increased from P1 to P2, total revenue changes. Total revenue 2 is equal to P2 times Q2, which is equal to areas C plus A. C plus A, which we can see here, this blue area here. Okay. Because area C is greater than area B, it holds that total revenue 2 is greater than total revenue 1. Thus, as price rises along an inelastic demand curve, the total revenue also increases, which we can see in the article that as price rises for crude oil, profit margins, total revenue for oil refining firms is increasing. So we've basically answered that question. We've provided an appropriate model. We've answered the relationship between price and total revenue in the context of PED for primary commodities, and we're essentially done with that question. If you have any questions, feel free to comment those questions below, and don't forget to subscribe and to like. And a full outline of this analysis is in the video notes below. Thank you so much, and until the next video.